In part 1, we covered what trading bots are, where they came from, and how the different types work. If you haven't watched that yet, go back and start there. This series builds on itself. Today is part 2. And this is the one the bot sellers don't want you to watch. Because today we're going behind the marketing. We're talking about what actually happens when real people put real money into trading bots. The hidden costs they don't advertise. The failure modes that don't show up in the sales screenshots, the ways these systems fail slowly and then all at once, and the specific red flags that separate the tiny minority of bots that have a real edge from the overwhelming majority that will drain your account over time. Let's start with the thing that sounds obvious but almost nobody accounts for: fees. Fees are the silent killer of bot strategies. Every trade your bot makes costs money. That might be a trading commission, usually small now, often fractions of a cent per share in equities, or a percentage of trade size in crypto. But small adds up when your bot is trading dozens or hundreds of times a day. In crypto especially, most exchanges charge a maker-taker fee structure. Takers, traders who place market orders and take liquidity from the book, typically pay around 0.1% per trade. That sounds tiny. But if your bot is executing 100 round trips a month, 100 buys and 100 sells, that's 200 trades at 0.1% each. On a $10,000 account, that's around $200 a month in fees just to break even. $2,400 a year. Your bot needs to return more than 24% annually before fees just to keep you at zero. That's not a passive income strategy, that's a treadmill. And that's before slippage. Slippage is the difference between the price your bot expects to trade at and the price it actually gets filled at. In liquid markets with tight spreads, this is small. In less liquid markets, or when your order is large relative to available liquidity, you can lose an additional fraction of a percent on every trade just getting in and out. Slippage is almost never modeled accurately in backtests, because backtests assume you fill at the exact price you see in the historical data. Real markets don't work that way. Your market buy fills at the ask. Your large order moves the price against you. Slippage compounds across hundreds of trades until it eats your edge. Then add spreads. If you're trading on an exchange with a 1 basis point spread, that's 1/100th of 1%, each round trip costs you at least that much just from the bid-ask. In volatile conditions, the spread widens. If you're grid trading and filling dozens of orders a day on both sides, the spread drag is constant and compounding. Here's the cold math that most bot sellers will never show you. A bot strategy needs to overcome fees, slippage, and spreads before it produces a single dollar of profit for you. In the backtest, the strategy looked like it was printing money. In live trading, it's bleeding out one tiny cut at a time. Now let's talk about the regime problem. This is the one that kills more bot accounts than almost anything else. Market regimes change. A regime is the underlying character of the market. Trending, ranging, volatile, quiet, correlated, uncorrelated. A trend-following bot built and optimized during a strong trending market will fail catastrophically in a choppy, mean-reverting market. A mean reversion bot that worked beautifully in 2021's range-bound crypto environment got destroyed when Bitcoin started trending violently in 2022. A grid bot that prints steady gains in a stable range gets wiped out when the price breaks below your grid and never comes back. The problem is most retail bot users don't know when the regime has changed. They see drawdown and think, the bot is doing its thing, just wait it out. But the bot isn't in a normal drawdown. The market conditions that made the strategy work no longer exist. The bot is operating a playbook that doesn't apply to the current game, and it will keep executing trades based on rules that have stopped working until either the market comes back to the regime the bot was built for, or the account hits zero. Professional quant firms deal with this through regime detection. They monitor market microstructure in real time and turn strategies on and off based on whether conditions favor them. Most retail bots don't have anything close to this. They run the same rules regardless of whether the regime suits them. And you, the person watching the dashboard, have no reliable way to know whether you're in a normal drawdown or a strategy that has fundamentally broken. Now let's talk about the bot marketplace problem, because this is where the real money is being made. And it's not by the traders. There is an entire industry built around selling trading bots, subscription services, bot marketplaces, signal groups, managed account services, copy trading platforms. The pitch is always the same. Look at these returns. Look at these back tests. Look at these Discord screenshots of people making money. Here's the monthly fee. Here's what you need to understand about almost every bot sold on a marketplace. If it was actually consistently profitable, the person selling it wouldn't be selling it. They'd be running it quietly with $100 million of capital, retiring early, and never talking to anyone. The fact that it's being marketed to you for $99 a month is itself the strongest possible signal about its actual value. This isn't speculation. It's the basic logic of markets. If you had a machine that genuinely printed money, you would use that machine to print money. You would not package it up and sell it to strangers. The moment you sell a profitable strategy widely, you dilute its edge. Everyone trading the same signals competes with each other. Slippage increases, the patterns get front-ran, the edge disappears. The only rational reason to sell a strategy is if the strategy doesn't work well enough to be worth running privately, but it's easy enough to sell convincingly. The screenshots you see in marketing materials are cherry-picked. Backtests are optimized to historical data. Testimonials are real customers who happen to use the bot during a favorable market regime and who stopped posting when the regime changed. The business model of most bot sellers is not help traders make money. It's sell subscriptions. There's a specific pattern to watch for. The seller shows you a backtest with a beautiful equity curve, steady gains, minimal drawdown, impressive Sharpe ratio. What they don't show you is the out-of-sample performance, how the strategy performed on data it wasn't optimized against. They don't show you the drawdown periods in detail. They don't show you what happens when you subtract realistic fees and slippage. They don't show you the 6 months after they started selling it publicly when the edge degraded from overuse. Ask yourself this question: when was the strategy built? On what data? And how has it performed since then in live trading with real money? If they can't answer all three clearly, you have your answer. Now let's talk about what actually blows up accounts. Because drawdown isn't just an emotional problem, it's an account-ending problem if you're using leverage. Leverage is the gasoline that bot sellers add to make their results look better. A grid bot with 2 times leverage looks twice as good in a backtest. It also fails twice as fast when the market moves against it. In crypto especially, bots are often configured to run with significant leverage, 3 times, 5 times, even 10 times, on exchanges that allow it. When these bots hit a losing streak or the market gaps against them, the losses are amplified by the same multiplier as the gains. A 20% adverse move with 5 times leverage is a total wipeout. The thing that makes leverage dangerous with bots specifically is that bots don't panic. A human trader who sees their account dropping 30% has a psychological override that kicks in. They close the position, they stop the bleeding. A bot doesn't have that. It keeps executing the strategy. It keeps averaging down into a losing trade. It keeps opening new positions according to the rules as the account spirals toward liquidation. The discipline that makes bots valuable, removing emotion, is also what makes them catastrophic when the strategy is wrong. There's also the operational risk category. Bots depend on infrastructure. They need a reliable internet connection, a running server, and stable API access to the exchange. An exchange goes down for maintenance. An API key expires, a server reboots, the bot misses a critical exit, or worse, a software bug fires the bot in the wrong direction and it places orders you didn't intend. These things happen, and when they happen in the middle of a volatile move, the damage can be severe and irreversible. So with all of this, is there anything that actually works? Here's the honest answer. Yes, but not in the way it's usually sold. The bots that actually work over time share a few characteristics. They have a genuine explainable edge, not just a pattern that happened to work in historical data, but a real reason why the trade makes sense. That might be a structural inefficiency in how liquidity is distributed at certain price levels. It might be a consistent short-term statistical pattern in how a specific asset reacts to a specific type of event. It might be genuine latency arbitrage between 2 correlated instruments. They have realistic expectations. They're not promising 30% monthly returns. They're targeting something like 10 to 20% annually. Competitive with the market, but achievable consistently without taking on catastrophic risk. They have defined conditions under which they stop running. If the market moves into a regime that doesn't suit the strategy, the bot knows to step aside, not keep grinding, not keep executing rules that don't apply. Stand down and wait. And they're operated by people who understand exactly what the strategy is doing and why, so they can tell the difference between a normal drawdown and a broken strategy. That's a very different thing from what's being sold to most people in the bot marketplace. And it's a very different skill level than most retail traders bring to the space. In part 3, we stop theorizing and go live. We ran an anonymous test bot. I'm not disclosing which one because it's still in development, on a real account with real money. No paper trading, no simulation. We show you exactly what happened, how it performed, what the fees actually looked like, and whether the results match the marketing. That's the one that either validates everything we've covered in these first 2 parts or makes us look like we missed something. Find out in part 3. Subscribe. It drops next week.